Hey guys, what's up? This is Bobby again with GrowthU, and today I've got a guest I'm really excited for. I had the chance to meet Jennifer Santoso just in the last couple of weeks, and she's the Associate Director and Capital Advisor at Tauro Capital Advisors. So I'm excited for you to be here. Thanks for spending some time with us today, Jennifer.
Thank you for having me. Good to see you here, face to face via Zoom.
Yes, yeah. So whenever we initially talked, you really kind of opened my mind to a few different things just in terms of the capital stack, creative financing, just some different approaches. But to start off, could you, before we dive into that, could you just tell us a little bit about yourself, your history, and then we can dive into some of this golden knowledge I think you can share with our audience.
Sure, yeah. So I was born and raised in the Bay Area, came down here to San Diego. I went to UCSD, University of California, San Diego. My major was a cognitive science major, and I had an ethnic studies minor. So, you might notice not having anything to do with business, econ, or real estate. I spent about 14 or 15 years with the Department of Defense, primarily as a client base, doing management and leadership consulting. And I am what I consider to be a lifelong learner. So after seeing organizational challenges and being able to provide solutions easier, I was wanting to move my career into the world of commercial real estate. And since it was a little foreign to me, I did what I do best. So I stood up a meetup on multifamily syndication just to learn about the industry and see where I would want to connect myself. I met Tauro Capital Advisors there and could not be happier. So that's where I am today.
That is so cool. It's wild. You say you started a meetup, and I saw that when I read about you on the profile on your website. And what's interesting is I had a friend who just moved to Hawaii, and she was like, I can't find any families to hang out with our baby. We're starting a running club, and now they've got like this huge community. So that's such a cool story that your meetup led to your job. I love that.
Thank you. I appreciate it.
Well, cool. Well, thanks for that intro. So let's dive a little bit into just capital stacks and like the creative financing options and like what you guys are doing and what you can share.
Sure. So on a broader level at Tauro Capital Advisors, we consider ourselves to be intermediaries. In other words, people might ask if we're a broker. The answer is yes, we're a broker, but we have a strong strategic and advisory perspective on the work we do when we work with our clients. We have relationships with more than 3,000 lenders and more than 500 equity partners. And when it comes to the capital stack, what that means is, we might provide the debt, we provide the equity. If people are coming to us with an equity request, we 9.9 times out of 10 will ask to do the debt with it. At first blush, it might look like we're being greedy, but what's necessary is that the two parts have to talk to each other. If they don't, it's almost a perfect recipe for a failed capital stack.
Got it. And let's so this takes me down a lane as someone who like doesn't work in this day in and day out. I know rates obviously were higher historically in the past. Now they're getting lower. What over the last few years or even like the last decade has been like the biggest shift in terms of financing, and like what is the creative way to finance now that's maybe night and day difference from, let's say, a half a decade or a decade ago?
So unfortunately, I can't really dive into the historical component of that. I just don't really have that purview at this point. But what I can tell you is that in terms of the creative portions, a lot of people might want to, so I'm going to back up just a little bit. Investors or sponsors typically want to come into situations and have an idea of what they're getting themselves into, right? So they do a lot of the research on their own. And they're going direct to lender, they're going direct to equity and bank, et cetera. They want to have an idea of what's happening and kind of have the power within their own hands to put together their solution. There's a lot of benefit in that, just so that the sponsor lender or sponsor investor doesn't feel like they're confused in the process. I've had that happen where people will do that in parallel to us working with them, knowing that they've signed an engagement with us, so they've hired us to do it, but they always end up taking longer, and they always end up finding the same results that we have found. So that's one point, just for some context. And in other words, long-winded way of saying, as they do that, they're learning what we're able to supply them right away or creatively.
Got it.
Yeah.
Okay.
And there's a lot more to it, obviously, but I'll just leave it at that for now.
Fair. Okay. And when it comes to the type of clients you serve, break that down a little bit. If there's maybe a couple of camps, or is it purely institutions?
Sure. So I'll speak first in terms of Tauro as a whole, and then myself as well. So as a whole, Tauro likes to do loans for properties at about $1 million up to more than 150 million in terms of loan and or equity size. Sometimes we'll go sub 1 million, maybe down to 800,000. That's typically when we have a client that comes to us night and day. We're always doing loans for them, so we know it's going to be a very quick process. Let's see, in terms of asset class, we do all asset types. So that includes office, industrial, storage, multifamily, mixed use, development / construction, senior living, and retail.
Okay.
And we do that across the nation. And as for me, I like to work on things with a lifestyle component. So retail mixed use is very interesting to me. Multifamily is an interesting one. I know a bit about it just because the meetup that I had stood up, but it's posed some interesting, I don't know. I think the clientele is a little bit different when it comes to multifamily.
Yeah, that's interesting. You brought up like the retail lifestyle. Like, one question I would have is, what do you think is, I know multifamily is getting overbid. We see it all the time. But as far as these different asset classes, like one of the asset classes I recently got into was business parks, because, if there's a chemical plant or something that's just not going to get shut down, that's needed for the economy for whatever reason, I want to be in there. So like, that's something recent from my experience. But from all these deals you're analyzing in asset types, what asset types would you say are maybe underestimated or that are being underbid, that have maybe like better upside versus what's been going on the last like 7 years in the hot market?
That's a really great question. I would say ghost kitchens. Are you familiar with ghost kitchens by chance?
Yeah, like if I had like a prepping business and I wanted to come in and use it type thing.
Yeah, exactly.
Okay.
I definitely say ghost kitchens. So you're seeing with the pandemic, you're definitely seeing a lot of more of a flexible lifestyle, a blend of live, work, and play, like more in one area. And so the onset of ghost kitchens is just making more sense, right? So you've got delivery, you've got the restaurants themselves could downsize on their own kitchen staff and work out of that ghost kitchen. So with Tauro, we've done a very high percentage of ghost kitchens through our lending capabilities. I would also say just the asset classes that people are underestimating. So retail, I would say office, and a little bit in senior living. So since all three of those have taken a bit of a dump or a dive through the last 2 years, they're being bid at slightly lower levels, very different, right, than industrial and multifamily. So if you're able to get into those for adaptive reuse or just to reposition it, so you're bringing the retail, for instance, into today's day and age of combining brick and mortar and also drop shipping or logistics use, then that's huge. That's a huge interplay for people today.
Love it. I actually saw one of the kitchens on your website earlier today when I was looking. So it's cool you said that. It must be booming.
Oh, yeah, definitely doing well with those.
Wow. And then you brought up logistics. I think that's super interesting. So I used to work at a digital marketing company, and I've watched Shopify and Amazon go absolutely absurd. And I had a 10-year head start on people. And, looking back, I'm like, hey, I should have bought all that stock. I knew it was big. We sold it to all our clients. I didn't. And then COVID just sent everything exponential. And we're seeing a lot of these buildings, like especially probably this next year, people are going to be going into more remote work, and they might not renew those leases. And you brought up something really compelling that actually has been on my mind is like logistics centers. Like, are there a lot of new third-party companies coming out who are saying, hey, Amazon's got their leg on lock. We actually want to support smaller businesses with lower costs. We found fruitful ways to do that. Can you speak on that at all?
Unfortunately, I'm not the one to speak on that.
Okay, that's okay.
I mean,
That's okay.
I would assume the answer is yes, just based on the whole, the way the market works. And whoever's got the cojones to go up against Amazon, that's good for them. Unfortunately, that's not something I can speak well on.
For sure. More power to them. Well, cool. Well, let's dive into one of the second topics we were just discussing a bit before, is the blended approach. So whether you should syndicate or take higher debt, maybe for a higher return. Taking on debt just doesn't seem like you would get more of a return. I think to like just a normal thinker, but with leverage, you do get larger return, right? Like, can you explain that a little bit?
Yeah, so this is what you and I had talked about over the phone when we initially connected, and I'm glad you brought it back up because it's something that I love to talk about. And primarily because there's a huge lack of awareness in this space. So now we're kind of touching on a little bit what you had brought up about creative approaches or just out of the box approaches that your standard investor, syndicator, sponsor would not typically be aware of unless they're very well seasoned, or unless they hire somebody else like us, trust our advice, and understand that we can provide creative solutions. So I'll just give you an example of what I've seen time and again with people who've been successful with syndicating. And in terms of success rate, these are folks who have been successful enough to phase out of their W-2 job and do syndicating real estate investing full time. So these folks typically might get a loan of maybe about 60-65%. They'll put a little bit of their own money into it, and then they'll syndicate the rest of that equity. So obviously, you and I know, but for those of us who don't know, syndicating that additional equity means using something like crowdsource or just raising money through friends and family, right? So that raise, typically, depending on the size of the property you're working on, usually, I don't know, anywhere between 2 to like 14 million. And I say that just because somebody who's syndicating usually works in a property size between maybe like 50 units to 150 units. So there's a benefit in that. Obviously, you get in the game, you develop those relationships, you build on your own capability, and then you build trust with your investors. The pro is that you've made headway, and it's fantastic. You can't lose that experience or that knowledge. The con there is that you've got these LPs that you've brought in. They have their own opinions, their own voices. Not all of them, but many of them do. So you're managing X number of opinions, communications, requests, payments, right? Checks that you're writing. And so it gets to be a bit of a bear, right? And it takes time to bring that money in.
Yeah.
Okay, so that's scenario A. So let's segue to what I like to suggest to syndicators. And it usually takes a bit of time for people to wrap their heads around this better solution, in my eyes. So if they're able to acquire a stretch senior loan, that stretch senior loan could go up to anywhere from 75 to 90% of loan to cost or loan to value based on, you know, the borrower and the deal, et cetera.
Okay.
And so when I say 70 to 90, it's not, it could be that it's a combination. So let's say hypothetically, it's 70% loan. Actually, okay, no, let me go back. So let's say it's an 80% loan to value. So it's actual debt, 80% loan to value. And the interest rate comes in at 6.5. So at first blush, you look at the rate 6.5 and you're thinking that's a high rate. I can get rates as low as the high threes or low fours. But that's on a shorter loan. And you've got all that syndicated money that you're managing. So you're paying your equity people the 8 to 12% preferred return. And then you've got the profit division that you're also paying those folks out at. So when you take a look at that blended cost, it actually comes in higher than if you were to take out that 80% loan to value loan stretch senior at the 6.5. So you're syndicating less, and the blended rate of that situation is lower. So you're saving money than the first situation.
Yeah. So I'll try to say this back and see if I'm expressing it the right way and understand. So like whenever you say get that rate, high threes or fours, but you've got LPs, the loan's shorter. So you're kind of in a race to like hit the pref so you can earn yourself as well to bring value to the deal. Otherwise, you could take higher debt at a higher rate, but you don't really have this LP hurdle and you've got more time. So now you get to own the asset potentially longer and you're not in a rush to maybe refinance or sell. Is that the right frame of thinking?
For the most part, so you're definitely still raising LP money in the second scenario, but instead of having more time, you're simply spending less time on the LP raise, right? So hypothetically, you're raising from LPs. In the first scenario with more LPs, you might be raising from, I don't know, 50 to 100 people, right? Or you might have a huge database you're pulling from. In the second scenario, you just have a lot less folks that you're raising from. And so that takes you less time.
Makes sense.
Yeah.
Cool. That's awesome. And as far as like, so that's a good example. You kind of gave us some hypotheticals, situation A and B, kind of broke down what that exactly means. Do you have any maybe cases, like maybe a case or two without giving us too much detail on how this has been used just in the last year and a half potentially?
Just in terms of like the stretch senior and having better blended rates and whatnot.
Yeah, maybe if there's like just a story you could tell before we move on that just kind of is like a real life example, like a success story potentially.
Definitely, yeah. So I had this one client come in, and so he kind of touches on a couple of points I brought up. He came in asking, knowing that when we provide equity, we 99.9% of the time want to have the debt as well. So he came in for a very, very small equity request. It was 3 million, and he's like, we already have the debt in hand. The debt provider is on our sponsorship team, which, I'll reserve my comments about that. And he said, please, 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 I really like you. I really want to work with you. Let's see what we can do. So I said, we'll see what we can do. And sure enough, what came, so his initial debt solution was 65%, just as usual, right?
Yeah.
And so our recommendation was two-part at the beginning. And it was, you're either going to need a lower leverage loan plus higher institutional equity, because institutional equity wants to see that your leverage is safe, right? They don't want to have you over leverage with higher risk. So you're going to either need that scenario, or you're going to best play with that stretch senior, and we're not going to play at all as institutional equity. So of course, after we tapped the market, we hit the streets and talked to our equity folks. It literally came back just as we had mentioned, right? They said, we won't work with 65% debt. We could play in the equity space, but they're gonna need a smaller loan. And then of course, the one best solution that came out, as you could see, I was referring to this in my mind, talking earlier, was literally that 80% stretch senior with the 6.25% interest. That's damn good. Like, you tell that to an experienced operator and they're impressed. They're like, I would take that any day. So this group had ended up rejecting that because this solution in particular didn't allow them to cash flow year one. They had ended up sticking with their loan, putting in for like 3 or 4 extensions, of course, paying for those extensions along the way, working super hard syndicating, and it was really difficult for them to syndicate. And they kept coming back to me for additional sources of money. I said, I can't turn a no into a yes. And I'm not going to reach out to the same people who already told me no, just in general. That's just uncouth, poor form. I'm not going to do that.
Yeah.
So they ended up pulling out a hard money loan to close the gap. And so they're still in further debt on that range, but just kind of goes to show, where our advice is worth something. And, you pay to save yourself headache at the end of the day. This was an extremely tough close for them. I think they stretched out their closing period for a total of maybe like 4 or 5 months.
Costly decision making, that's for sure.
There you go. Yeah.
Yeah, it's interesting. We always talk all the time. Like, we ran our numbers for the year, and last year we analyzed 18 billion in deals, and it's just like, we're not going to try to force a bad deal. And you hear stories like this, and it's just, it's wild. And I have a few friends who syndicate, and they're all like, I need to start a course and like educate people on how to analyze deals, because so many of them are bad. Like, people are trying to force the numbers, and that's another good story. So that was good to share. Awesome.
I'll just mention really quick on that note. I'd like to, so I'm not the super brain analyst, but we have fantastic analysts at Tauro. They definitely will just look at the underwriting and just in 2 seconds, oh, this is just financial engineering. We don't want to play in this one. Like people can read through that stuff, and we want to work with clean deals and clean operators and not just fudge the numbers to pretend like it's going to be a great deal.
Yeah, I love that. Well, nice. So one of the other things we were kicking the idea around on was just having like good perspective. Like if you're feeling limited with a certain type of strategy, how can you approach it? And I know you guys have a pretty big network of lenders and equity partners. So tell us what type of freedom and just ability that gives you maybe versus other advisors.
Are you saying as opposed to other competitors with Tauro, or just direct
Yeah,
lenders, or?
yeah. Basically, you just mentioned like you have like a deep bench of equity partners and lenders in general, and maybe due to that, I guess, reach and breadth of access, maybe that gives you people that have different perspectives in managing risk and getting deals done. The last example was a good, very extreme one, obviously, but
Yeah.
just like maybe share a little on that perspective and what you
Yeah.
guys are able to provide the market.
Absolutely. So I think there's two levels to that. So the first is that we do have that breadth of connections. We threw out the numbers, 3,000 plus lenders, 500 plus equity partners. Another benefit is that on a weekly basis, every Tuesday, our firm has a pipeline meeting, and we have both lenders and equity partners that guest at those meetings every single week. So we consistently have a fresh view of who our lenders are, what's new for them, what's middle of the fairway deal for them, what are some hero deals for them. So we consistently are getting what's new and fresh from our lenders. That's number one, and our equity partners. Number two, I would say it's, first is the breadth, but secondly is the quality, right? And so aside from having that knowledge, I would say that we pride ourselves in knowing who the strong players are and who's going to be a good business partner. It's one thing to say, oh, we have a ton of great people in our network, but Tauro on so many different levels has such an incredible priority and focus on culture, both inside the company when it comes to the people that are hired and what the company chemistry is like. Like that's so important at Tauro. And secondly, we extend that out to our stakeholders as well. So if it's a gigantic institutional equity partner, we want to make sure that cultural ties are very common foundationally. I think we all know business it's not to be taken lightly. It's so important for us to do business with good people, great track record, honest, people who know how to have fun. So your initial question was, what type of freedoms, what are the benefits? I would say we've got the experience. We definitely take the work off of your shoulders, right? So we here at Tauro believe that the sponsor's time is best spent on the real estate and on the strategy. We take the financial load off of their shoulders. And I also will, I definitely cannot miss this point, but I myself have literally never had as much respect and admiration in my entire life for my company leadership than I do here at Tauro. So, and that's like an honest statement. So I've got Steve Stein and I've got Scott Lee. So Steve has a background with George Smith Partners and Marcus and Millenchap. He had run 12 or so divisions across the West Coast. And Scott Lee, he is just remarkable. He's the numbers person. He led the JV equity division at GE Capital. So that's, no small thing.
Awesome. Well, very cool. And I want to hear a little bit too, just more on the meetup thing, like a little more personal stuff now. So what initial conversation or story led you to want to learn about syndications and then make the bold move of just, I'm going to step out there and do my thing and learn?
I love that you asked that question because it's not something that I've heard many people do. So I was listening to Bigger Pockets like many of us do years ago. And there were lots of stories on flips or ADUs or, house hacking. And it all sounded interesting to me, but none of them really hit my gut. And there was this one show with Bruce Peterson, the syndicator, and he was talking about syndication. And I was just instantly drawn to the scale of it, specifically how it's more efficient, both financially and operationally. And he himself, had a professional background with Best Buy. And then he himself started a meetup and was able to learn about the industry and gain trust in the people who attended the meetup. So I just thought, with my background in, management consulting, leadership, and facilitation, I could easily stand up a meetup. I really am very much somebody who learns through people and through experience. So I said, this is a perfect thing for me to do. I did it and feel really happy that I made the decision.
That's great. It's neat when something like that out of curiosity just leads to such a fulfilling career. That's awesome.
Yeah, thank you.
Well, nice. Well, so one thing I think that's kind of a hot topic right now, it seems like every day there's some just wild news of things going on in the economy, rates, like houses are selling out like crazy. Like I was just going on a deep dive researching, there's less than 292,000 single family homes out there right now in the nation. What is it, 2015 or so? There was like 1.2 million. So there's a lot of pressure there. And then there's, I know you mentioned earlier you work in some of these other asset types, maybe not multifamily, but even with multifamily, what is it? We have more buildings coming up and doors available, but vacancy is lower than ever. But it's different in other aspects of commercial. But like, what's your kind of take and just where's your attention at in terms of just like the dynamic going on right now? If there was something that kind of really stood out to you.
Good question. I'll just mention a few things just in terms of, signs of the market shifting, and then I'll close with one kind of obvious answer. So the equity market and lending market when it comes to retail is thawing out. So obviously at the onset and middle of the pandemic, a lot of action really froze when it came to retail for obvious reasons, right? We don't want to be gathering too closely, but it's definitely beginning to thaw out. People understand that they do want to live their life safely. And again, as we're modernizing our retail centers to include the drop shipping or logistics component in addition to the brick and mortar, that allows the retail to continue to exist, but then move into this new day and age, right? So many people say, oh, it happened because of the pandemic, or you could take the perspective, it happened and the pandemic, or it was going to happen and the pandemic escalated this activity. So I'll say that you had also mentioned the bit about multifamily being like overbid and highly populated. So I'll say both multifamily and industrial were both performing just above where they were prior to the pandemic during the pandemic. I hope that makes sense the way you said it. So those two asset types have been doing very well. And again, for obvious reasons, right? We always need a place to live. If we're going to move out of house, we're going to downsize financially. And industrial supports the logistical element of having more flexible lives and having more drop shipping happening with industrial. I would say that for those of us who are aware of the book, I think it's Blue Ocean versus Red Ocean, something to that degree. I would say definitely multifamily is a very blue ocean market, or I'm sorry, red ocean market. In other words, there's just high population, high competition. It's not a cakewalk. Nothing is, but even more so. I personally credit a lot of that congestion to what I call, how I describe it as multifamily being, and specifically syndication being a bit of a self-licking ice cream cone. In other words, so you've got, I know I said that the other day to somebody and they're like, I just can't stop getting this image out of my head. But so, yeah. So the thought here is if you've got syndicators who are, needing to raise LP money and they're running out of money, right? Or they're running out of time to get additional or larger properties, And hint, hint, if you talk to me for a single institutional equity partner, that might be your solution, right?
Mhm.
However, so if you've got these folks, you're constantly having to create this customer base of LP partners. How do you do that? You write blogs, you write books, you create podcasts, you stand up meetups. And so you just teach new people and they start to walk the same path. And before you know it, it's this self-sustaining community of people who know the world of syndication. Obviously, if they succeed versus just dabble, that's a separate story. But then you create this like sub hub, if you will, of knowledge. And the truth is there's so much more out there in the world of commercial real estate and in the world of financing solutions. Okay, and the very last thing I'll say is, to your point, there's a lot of talk about interest rates going up. The natural and obvious response is get your refinances done. So obviously, Tauro Capital Advisors is happy to help with that. Any of our qualified competitors, I'd recommend as well. But it's just a fantastic opportunity to refi, out of a 10% loan or out of a bridge or whatever it is, get your refi on and keep that money in your pocket.
Yeah. We're going through buying a home and it's a new build and I'm just like, this is going to be fun just watching what happens over the next 9 months. So crossing my fingers.
Yeah. Yeah.
Oh man. Well, awesome. This was great to chat. And if people wanted to reach out to you and say hello, what's the best way to get in touch?
Good question. So I would go to the Tauro website. So it's taurocapitaladvisors.com. Tauro is spelled Tauro. And then you can hit the bullpen tab and you'll find my picture, Jennifer Santoso, in there. You can reach out to me directly. You can reach out to me on Instagram. It's at Jen Santoso, and that's Jen with 2 N's, and Santoso is SAN like Nancy, TOSO. And I think those are, 2 pretty good ways to reach me.
Awesome. Well, thank you so much for spending some time with us and educating the audience a little bit. Appreciate it.
Absolutely. Thank you so much, Bobby.